10 Best Dividend Stocks to Invest in. Dividend stocks are companies that pay out a portion of their earnings to a class of shareholders on a regular basis. These companies usually are well established, with stable earnings and a long track record of distributing some of those earnings back to shareholders. These distributions are known as dividends and may be paid out in the form of cash or as additional stock. Most dividends are paid out on a quarterly basis, but some are paid out monthly, annually, or even once in the form of a special dividend. While dividend stocks are known for the regularity of their dividend payments, in difficult economic times, those dividends may be cut in order to preserve cash. One useful measure for investors to gauge the sustainability of a company's dividend payments is the dividend payout ratio. The ratio is a measure of total dividends divided by net income, which tells investors how much of the company's net income is being returned to shareholders in the form of dividends versus how much the company is retaining to invest in further growth. If the ratio exceeds 100% or is negative, meaning net income is negative, this indicates the company may be borrowing to pay dividends. In these two cases, the dividends are at a relatively greater risk of being cut. In this video, we'll discuss about 10 best dividend stocks to invest in. Number 1. OneMain Holdings Incorporated (OMF). Forward dividend yield 13.14%, payout ratio 37.71%. OneMain Holdings is a financial services holding company focused on consumer finance. Through its subsidiaries, OneMain originates and services secured and unsecured personal loans and offers a range of credit insurance products. The company operates a network of 1,500 branches throughout the US and provides a digital platform that allows customers to apply for products online. On April 26, 2021, OneMain raised its minimum quarterly dividend by 56% to $0.7 per share. The dividend is payable on May 13, 2021 to investors who hold qualifying shares in the company at the end of May 6, 2021. Number 2. Sensata Technologies Holding plc (ST). Forward dividend yield 11.35%, payout ratio 0%. Sensata Technologies is a global industrial technology company that develops sensors and sensor-based solutions. Its products, which include motor protectors, circuit breakers, position sensors and encoders, pressure sensors and switches, and inverters and chargers, are used in a wide range of industries including the transportation, construction, healthcare, energy, and telecom sectors. Sensata Technologies confirmed on April 1, 2021 that it had completed the previously announced acquisition of telematics and data insight provider Zergo Technologies Intermediate Holdings LLC for $400 million. Number 3. AGNC Investment Corp. AGNC. Forward dividend yield 8.59%, payout ratio 22.14%. AGNC Investment is an internally managed real estate investment trust (REIT) that primarily invests in agency residential mortgage-backed securities (RMBS) on a leveraged basis. It finances its holdings through collateralized borrowings structured as repurchase agreements, repos. A repo is a type of financial instrument whereby one entity acting as a borrower sells a financial security to another entity acting as a lender and simultaneously agrees to repurchase that security at a later date and at a slightly higher price. Number 4. Booking Holdings Incorporated (BKNG). Forward dividend yield 7.63%, payout ratio 0%. 1-year total return 74.1%. Booking Holdings is an online travel company based in Norwalk, Connecticut that provides travel and restaurant reservation and related services through the websites of its subsidiaries. The company operates 6 consumer brands: Booking.com, Priceline, Agoda.com, Rentalcars.com, Kayak, and OpenTable, and is active in more than 220 countries and territories worldwide. Number 5. Las Vegas Sands Corp. LVS. Forward dividend yield 7.44%, payout ratio 0%. Las Vegas Sands is a global integrated resort developer and operator. The company owns and operates 8 properties in 3 locations: the Venetian Resort Las Vegas and Sands Expo and Convention Center in Las Vegas, the Venetian Macau, Sands Macau, and the Londoner Macau, the Plaza Macau, and Four Seasons Hotel Macau, and the Parisian Macau, all located in Macau, and the Marina Bay Sands in Singapore. Las Vegas Sands announced on March 3, 2021 that it had reached an agreement to sell its Las Vegas properties, including the Venetian Resort Las Vegas and the Sands Expo and Convention Center, to affiliates of Apollo Global Management Incorporated (APO) for approximately $6.25 billion. Number 6. Aegon NV AEG. Dividend yield 3%. Never heard of Aegon? Well, with shares that have surged more than 20% year-to-date in 2021 but still trade for less than $5, you may want to learn about this company. AEG is no small fry, as it's a $10 billion financial firm that is one of the most respected asset managers in Europe, with a focus mainly on insurance, pensions, and investing services worldwide. This mix allows it to profit from cyclical upturns like some big ranks, and more importantly for income investors, the company's regular stream of cash from premiums and pension funds ensures reliable performance to support its dividend payments. Just beware that as a foreign dividend stock, AEG doesn't stick to the fixed quarterly cycle like US dividend payers, and only pays 2 distributions each year that can vary significantly in size. Number 7. Annaly Capital Management NLY. Dividend yield 10.1%. A diversified capital manager, Annaly Capital Management invests in residential and commercial assets primarily through mortgage-backed debt and similar securities. This cheap dividend stock took a big hit in early 2020 on pandemic fears, but it has rebounded from its March 2020 lows. Furthermore, the rebound has been sustained as shares logged 8% gains in the last few months, roughly in line with the S&P 500. Payouts are holding steady at 22 cents a quarter, and investors can rely on the massive portfolio of real estate investments to keep generating a decent flow of cash and deliver tremendous yield despite a low share price. Number 8. Pitney Bowes PBI Dividend Yield 2.32%. Pitney Bowes is one of those companies that was very popular in decades past but has struggled to keep up with the times. Though it currently bills itself as a technology and e-commerce solutions company, the fact remains that PBI was and still remains a company that is concerned with physical mailing. In fact, co-founder Arthur Pitney invented one of the first commercial postage meters about 100 years ago. While there is still some money to be made in direct marketing services via mail and parcel-related logistics, the truth is that PBI is a much smaller version of itself than it was decades ago. The good news is that shares have been beaten down to single digits and they now appear to have found their footing. The $1.4 billion company is actually up 375% in the last 12 months, proving that there's still value here for shareholders beyond its steady dividend payments. Number 9. Enable Midstream Partners ENBL. Dividend yield 9.94%. Like many energy stocks, Enable took a bit of a tumble last year as pandemic disruptions sapped oil and gas demand and caused prices to drop. ENBL weathered the storm better than most thanks in part to its midstream model. As the term implies, the company is in the middle between exploration firms and the refiners and wholesalers that are at the end of the supply chain. As a glorified toll collector in the energy-rich areas of the Dakotas and Oklahoma, as long as someone is drilling, there's a good chance that ENBL will be helping them move those fuels around. That provided a nice foundation for revenue even during the worst of the pandemic and continues to fuel a reliable and generous dividend. Number 10. Prospect Capital Corp. PSEC. Dividend yield 9.1%. Recently highlighted as one of the most generous monthly dividend stocks on Wall Street, Prospect Capital is also incredibly affordable on a per-share basis right now. But don't think that means this stock is in a death spiral, as shares have exploded higher from their 2020 lows to hit their highest point since 2017. PSEC has a diverse portfolio of investments that includes everything from consumer good manufacturers to energy companies to healthcare firms, which helps to provide a bit of stability to its monthly 6-cent dividend. Its focus on investments in smaller companies also means it's in the perfect position to capitalize from the post-pandemic recovery as the US economy slowly returns to normal in 2021. Thank you guys for watching. If you want more videos like this, make sure to like the video and hit the subscribe button, and we'll see you in the next video.